My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Love you, my friends. I'm just trying to make you a little money. My job is not just to entertain and educate, but I want to teach you and explain. And tonight I'm doing it. So call me at 1-800-743-CBC or tweet me at Jim Cramer. We too often invest for the day. I always hear people talking about what's working at the moment. And in the old days, when the great Mark Haynes ruled the mornings around here, I remember that each time I co-hosted, he would introduce me as Reverend Jim Bob from the Church of What's Happening Now. It was fun back then. It seemed like everyone was running their own personal hedge fund. There was an understanding that a stock could be here today and gone tomorrow, and everything was fine. Everyone was fine with it. Those days are over, though. And if you recommend a stock for a trade, even if you say, buy it today for the analyst meeting tomorrow, and then you sell, there will always be a video, a YouTube, kicking around, shows you like the stock, but never gave the sell call. So we've gone beyond that. We're all about educating you to be a better investor. The same thing we do every day at a higher, intense level at the CNBC Investing Club that I want you to join. Tonight, I want to introduce you to this concept that is so important, and it's called suitability. Basically, what stocks fit you? What investments are right for you? Not for this week, not for this month, but for your age, for your temperament. I first heard of the concept of suitability when I was in training at Goldman Sachs for the group that helps small institutions and individuals, now called Private Wealth Management. I've been buying individual stocks for myself and others for a half-decade before I got to Goldman in 1983 as a summer intern. At the time, I was watching Financial News Network between classes at Harvard Law School. That was the predecessor to CNBC. Whenever I could, I'd run over to the Harvard Business School library, where they had all these old research reports from long-gone firms like Bache, Shearson Lehman about stocks, totally on a catch-as-catch-can basis. Those of you who grew up with the internet have no idea how hard it was to access information in the 80s. If I liked a company, I would have to ask the librarian for a microfiche of the firm's SEC filings. I don't know, do they still have microfiches? These were little pieces of plastic that you stuck into a machine, and you read the filings, all of which were usually 6 months old by the time I got them. Everything I did back then is online now and instant and updated. The imperfections in the market back then were legion. Now everyone can know everything, but more on that later tonight. I'd spend all week trying to find one stock that I thought would work, one stock that would be good for a week, where anyone who wanted to invest could take the idea. And then I'd change my answer machine. Yes, my answer machine, another thing we got rid of. I'd change the message to a 20-second wrap on the stock. Don't know answering machines? Can you imagine? Well, some company used to make them with all those jobs wiped out by your cell phone. Same with the answering services, for that matter. Talk about jobs that aren't coming back. Anyway, I'd say, hi, this is Jim. I'm not here right now, but I like both the chart and the recent numbers from People Express, a long-since bankrupt airline that I used to jet down to New York for job interviews. My best one, a recommendation from Monolithic Memories, a smoke show of a company with a red-hot stock that was run by a guy named Zeev Drury, who, 2 decades later helped save Tesla back when it was struggling during the financial crisis. He was the last CEO before Elon Musk. Anyway, Monolithic shot up like a rocket that week and ultimately ended up being acquired by Advanced Micro Devices at a very big premium. It was the best Kramer's Not at Home call this machine hit I had ever had. And believe it or not, Jim is not home became a rallying cry for lots of people who were calling me back then, hoping I wasn't home so they could get the tip without having to interact with me. Not long after I got a job at Goldman Sachs, one of the officers at the firm called me in and got the machine with this he heard the recommendation. He told me to call as soon as possible. I did, and he asked me if I knew what suitability was. I had no idea. So he introduced me to the concept. He asked me, did I ever consider that many people who called me may not be ready for the stock of the hottest semiconductor company in the land, and that I was recommending it to them one-on-one without any sense of it, whether it was right for them? Suitability. Was it suitable? I said I always thought the stocks were pretty much a caveat emptor situation. We all know that, unlike, say, vacuum cleaners, you can't take stocks back to the store and get a refund. They come with no guarantee, so what's the deal? This executive hammered it into my head that before you recommend a stock on a one-on-one level at a registered brokerage house of all places, you had to know what that person wanted out of what did they want from stocks. You had to know if the stock was right for them and for their level of risk tolerance. Monolithic Memories, he said, wasn't exactly right for anyone other than the most risk-seeking investors out there, the financial equivalent of bungee jumpers. So let's start there. Today, I want you to ask yourself, what is your tolerance? How much risk do you want out of a stock? You see, stocks are pretty peculiar pieces of merchandise when you think about it. You buy a car and you know it's not worth as much the moment it leaves the lot, correct? But there are all sorts of warranties. You buy a house and you know it could burn down the next day. However, you can buy, before you buy it, you get a binder with insurance. So if it does burn down, you can get your money back. Clothes can be returned, devices returned, phones, PCs, washers, dryers, you name it. But stocks? If you buy a share of Nike and the next day Goldman Sachs downgrades it, and then a day after Foot Locker says there's a bit of slowdown in Jordans, you can't go back to your broker and say, hey, Chief, you never told me this can happen. I'm down $300 on 2,000 shares, and I'm out of hey, man, I'm losing too much money. I want my money back. Sorry, caveat emptor. Now, back then when I got started, it would have been incumbent upon the broker to recognize that the buyer would know these things could happen. Maybe the broker should never have been recommending that stock to begin with. You get the point, though, because you can't take stocks back and get the same price because there's no real insurance, although you could buy an expensive put option underneath with a cost that lowers the risk of Nike pretty dramatically and has to be renewed constantly. Suitability is incredibly important. That's why for the next hour, you're going to learn how to measure your own tolerance versus a variety of factors. Because these days, with digital brokers, there's no real protection. Just a signed form that says you get it. You may not know what you're getting into. Tonight, the bottom line, that stops here. By the end of this show, you'll know what suits you and what doesn't, no matter what your age or your style. Or to put it that another way, caveat emptor, no. Just buyer, be a little more aware of what you might be committing your hard-earned dollars to when you purchase a stock. Let's take calls. Let's go to Kyle in New Jersey. Kyle.
Best friend, Jim Cramer. How are you, buddy?
I am good, Kyle. Thanks for calling. How can I help you?
So I was wondering, first of all, I am an investment club member, and this is my third time talking to you, man.
Terrific.
And I feel like I know you personally. I love you to death.
Thank you.
I would like to know how often you look at RSI or MACD data when you're buying or selling a stock.
How often do I look at the relative strength index on the back? I have to tell you, I look all the time. I do not like to buy stocks where the chart is bad. It's one of the reasons why we do off the charts on Tuesdays. I think it's incredibly important, Kyle, because others do, and anything that's important to others is important to me. Mark in New York. Mark.
What is up, Jimmy? Chill.
Chill, man, here. What's happening?
I have an IRA account.
Okay.
I have an IRA account for my retirement, and I was wondering if it's okay to take some profits and then reinvest the cash in my account at another time.
Well, you know, I prefer you to let it run unless the stock is really sour, because I just think I don't want you to remember we're investing for the long term in IRA. And I have to believe that what you saw in the stock is continued. Otherwise, look, if you have to take a loss, take a loss. But keep investing in your IRA. That's the best thing to do. Let's go to Nick in Florida. Please, Nick.
Booyah, Jimmy, chill. My question, when you help your children invest, is it more important to save up and give them, say, a big snowball, a big lump of money when they get married, or set them up early, literally an infant, pay the baby, with, say, a small amount in dividend stocks, to rephrase it in such a way, which is more important, the size of the snowball or the height of the hill that compounds it?
Wow, I love that. Well, first, I can't help my kids. They have to do that on their own because of my job. I'm not allowed to know what they're up to. But what I always say to my kids is that, look, I want you to go make as much money as possible with half the money, and the other half I want you to do index funds and go learn some stocks. I think when they finally decide what they're going to do with their lives, they can do it. But that's my advice to them now. I don't know what they own because that wouldn't be right. By the end of tonight's show, I hope you'll know what suits you and what doesn't, no matter what your age or your investing style. Tonight, I'm helping you form the necessary investing strategies you need at all stages of your life, from young to old, just like the gentleman we just talked to. I'm going to meet you where you are and take you where you need to be. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.